let's talk about event-driven plays. As the name says, these consist of trades that either want to detect or cause a significant event in a company's life. For example, detecting a possible bankruptcy or a possible merger or sale. Let's take a closer look at these types of strategies. Event-driven plays, as the name indicates, are investments that are based on significant events or changes to a company. The fund can predict these events or they can actually cause them, and these can be varied. They can include, for example, first, merger arbitrage. This means predicting a merger before it happens and capturing the stock price difference of both companies before and after. Then, distress that. This means investing in a company that is in bad shape and then profiting from its recovery. It's usually a longer-term investment. Third, activism investing. This one is very popular. This is the name given to buying shares so that the fund owns a small but significant share in the company, and that is enough to be at shareholder meetings and propose strategic changes, which improve the value of the company and make a profit. And finally, private issue or Regulation D investments. This seems complex, but is simple at its core. There are companies that have both public securities and private securities, such as corporate bonds. And what usually happens is that there is a set of public securities that is offered to the public market and a set of private ones, which are usually similar but only sold to sophisticated investors and usually at a discount price. Activism investing, in specific, is probably the most known type of event-driven investment, and it works in the following way. The hedge fund identifies the company that they want to cause changes in, and they buy a small position in that company in terms of shares. This makes them officially a shareholder, even if a minority one, and therefore allows them to access information, shareholder meetings, reports, and more. Then, after reading this information and speaking with other shareholders, if the hedge fund believes that they can add value by changing the company's strategy or operations or other elements, then they buy more shares to have more influence, more board seats usually. And then this allows them to present a plan for a change to the company's board of shareholders. And this presentation can be friendly or hostile. The management team may not agree to it at all. And what happens is, this plan is hopefully adopted, and then the company increases in value, and every shareholder naturally profits from a boost in the share price. These optimizations can be in terms of the company's strategy, in terms of optimizing operations, better corporate governance, financial restructuring, management team incentives, or others, as long as the company improves in value. What are some examples? The first is activism in small cap companies. Although activist plays can occur for any type of company, they are more frequent for smaller companies. This is because the management team is usually inexperienced, and therefore there are usually more optimizations possible. Then, performing securities arbitrage is another example. For example, as we mentioned, for private issue securities, the private issue securities are going to be lower valued than the public issue securities. So instead of just buying the private issue ones and waiting for them to go up in price, the hedge fund can arbitrate the difference in price. So they can short the public securities, which are overpriced, and go long on the private securities, which are underpriced, and then wait for the price to converge. This is a type of arbitrage known as capital structure arbitrage. And finally, distressed debt investments are also made by private equity firms, But the focus of hedge funds is slightly different. Private equity funds focus on the company's actual operations, their fundamental conditions. They want to increase its multiples and its shape as a business, while hedge funds only care about the share price, so that the shares can be sold for a higher price. What are our key takeaways here? The first is that event-driven plays are strategies based on significant events in a company, either predicting them or causing them. Activism investing consists of owning a small position in a company, enough to be heard as a shareholder, and then presenting a plan that improves the company and makes a profit. The stress that consists of taking companies that are in bankruptcy or near that shape and helping them recover, making a profit. Private issue strategies consist of targeting specific companies that have both public and private securities, and since the private ones are usually at a lower price, buying the private securities, or even doing arbitrage. And finally, merger arbitrage, also known as merger arb. It's simply predicting that a merger will occur between two companies, or even an acquisition, and holding positions in both so that you ride the wave of their stock price increasing when the merger is announced before it happens. So as we see, equity-driven strategies are all about events in a company's life. You either detect them, such as with merger arbitration, or you actually cause them, as with activism investing, and you usually profit from the change in the company's share price.